Good afternoon, everyone. In today's video, I thought it would be interesting if we compared and contrasted today's FOMC volatility with the volatility we saw inside of January's meeting's volatility. Let me change this color so it's a little easier to see. This is January 22's video. I'll leave a link to it in the description box below, but let's do a quick recap of the similarities and the differences. Now, first off, in January, this is the overall move that we saw. We had an initial spike up and a fade of that reaction. That fade of the reaction is where price actually entered our volatility box models. And from there, we had a nice move up. So that's the overall gist of what happened. A few other things to call out. One is we were on our doomsday conservative models, which suggests that there was a lot of volatility that particular day in January 2022. During that FOMC event, we were in fact on our most conservative model available to us. We have 5. Doomsday conservative is at the very end of this. So that tells you that overall, this FOMC event was not for the faint of heart. It required insane amounts of risk, but it also meant that there was a lot more volatility involved, which meant the rewards were greater. Now, if we bring this into today's event and see what price action looked like, today we did not see that same initial reaction that we saw in January of 2022. So that was one difference. The second difference that I think stood out is we were on our conservative volatility box when everything was said and done for the actual long entry. Compare that to, again, January's event when we were on that doomsday conservative model. So between those two, that already suggests to you right off the bat that today's event had a little bit less volatility compared to the event in January. So that's point number 2, or difference number 2. Now, in terms of actual entries, we had something fairly similar to January happen, where by the time price actually gave us that overbought, oversold confirmation signal, price had already moved away from our sign entry line. To give you a full rundown of what actually happened today, let's start at the beginning of the 11 a.m. hour. So once the meeting minutes came out, we had the initial burst of volatility. That move was towards the downside. So for anyone looking for that fade of the initial reaction, we would have actually expected, since the initial reaction was a downside move, a fade in the positive direction, giving us a short opportunity. That did not happen. So that again went away from, I think, what we saw in January. Instead, we saw continuous selling with the bears having full control here. Now, the first time we had an edge signal, and this is again off of that 1-minute time frame chart, and the edge signal is our overbought, oversold indication, plotted by these green and red arrows, was on the candle of 11:17 a.m. Pacific time. Now, the difference there was that first breach that we had was off of our aggressive volatility box model. Let me load that in right here so we can see it. So we have the aggressive models loaded in, 11:17 candle, price breached our sign entry line. We were looking for that oversold confirmation. And for those that were trying to be a bit more aggressive and use that 1 minute instead of the 3-minute chart, which again, if you haven't seen the video of adjusting to the current volatility and switching over to that 3-minute video, I've left a link to that in the description box as well. But let's say you were trying to be a bit more purposely aggressive. Well, off of that 1-minute time frame chart, we had the edge signal at 11:17. 11:18 gave us an opportunity to enter at the sign entry line. That basically gave us a risk of right around 16 point, let's call it 5 points. The max move that we actually saw in our direction was only 9.25 points before price then reversed and we ended up going outside of the volatility box clouds. Once we went outside, this broke outside of the aggressive. This also broke outside of the doomsday aggressive. And we finally ended on that conservative model that I had plotted initially. Now, that's where we essentially come in now back into the charts. 11:36 is the next time where we had that 1-minute edge signal. Now, before then, the thing I thought was a similarity between today and January's event was what price action looked like headed into the edge signal. We see here we had bars 1, bars 2, bars 3, and bars 4. All 4 of these, we saw long wicks towards the bottom. We saw buyers coming in. If we switch this back over to January's event, we can see something fairly similar here. We even called this out in January where you had wicks, 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 and wicks before you finally saw the edge signal confirmation. So one similarity there where you saw buyers gradually starting to come in. It wasn't some drastic move up, at least if you're using the 1-minute time frame chart. Now, once we had the edge signal today, price hit not only T1 and T2, but then continued to make a move all the way to our other short entry lines, suggesting we were now looking at a short had this not been towards the edge of an hour. This candle was 11:55. Now, one other contrast that I'll make here is if we load in that 3-minute time frame chart, for those of you that were being a bit more cautious, being a bit more conservative, waiting for that new adjustment to the volatility that we're looking at, the first time we saw that edge signal was 11:36. From that close of the candle, the additional risk required was right around 16 or so points, 16.25 on the S&P 500. However, the actual bull rally that we saw after that was one that even I didn't see coming myself. It was about 100 points from the close of that candle, a fairly substantial rally with buyers just continuing to buy high after high after high after high. Each candle's close was being bought up. In fact, from the actual entry right here, if I come back into a 1-minute time frame chart, similar to that price analysis that we did in our previous video, let me come back into our current hour right here. What you should notice is we made a higher low, what you should notice is we made a higher low, another higher low, another higher low, another higher low, another higher low. This candle right here is the first time we made a slightly lower low compared to the previous candle. And again, that same trend continued. Another higher low, another higher low, another higher low. Again, one candle where it broke, and this pattern kept repeating itself. The only one time we saw a real pause is where we hit the other side sign entry lines, had a bit of a reaction from there, but even the bears here had absolutely no control. We saw bulls very much in control after that initial bounce from that 11:30 time frame mark. So again, to recap the similarities that we saw, the similarities was of course increased volatility. We saw buyers coming in a little bit more gradually for that final reaction move that we ended up actually seeing. Once we had that reaction move, we saw buyers really have full control here for the rest of the day. We also were most definitely not on the aggressive or the doomsday aggressive models in terms of which actually held, but that conservative was where the move finally stabilized itself and we started to see buyers come in. The differences here were, of course, in January, we saw a little bit more volatility. In January, we also had something similar where by the time price actually reacted, we never got an opportunity to enter at that sign entry line. We can see that if we go back just a little bit, by the time we had the edge signal confirmation, price was well outside of the sign entry line. In fact, we hit the first target. We also had a nice little buildup in January compared to today's price action. That buildup only lasted 1, 2, 3, and 4 minutes before we finally had a little bit of a breakout there. So hope today's differences and similarities helps to contrast how maybe FOMC event volatility days end up actually being. Of course, this is all looking after the fact here. In terms of how I actually managed the trade today, I tried to use SPY to essentially mitigate the risk involved here. And even then, I definitely made my own fair share of mistakes here, taking the more aggressive entry first, and then finally trying to take the conservative entry and still getting out much too soon compared to the actual rally that we ended up seeing. So this is all still learning lessons. I'm hoping that by the end of a few of these FOMC events, we have a much better model for trading FOMC in particular, along with videos where we can go back, study price action, see what actually ended up happening, and try and find some of these repeating patterns that we can then take advantage of. In January, we had the initial reaction, a fade of that reaction, and that move ended up being the actual move that carried on for the rest of the day. In today's case, we did not have that initial reaction. In fact, we had almost what you would call a V-shaped reversal here where price bounced down and then price bounced directly up. As V-shaped as you could get, with the bulls having a massive rally into the close with a nice almost 110 point rally from the actual sign entry line and about 100 points from the actual close of that first candle off of that conservative volatility box models. All right, hope today's video was helpful for those of you trying to trade these markets and today's event. Take care, everyone. Good luck trading, and we'll see you in the next update.